Hi everyone, Happy New Year, welcome to 2011. So this is the first video that I'm doing for this year, and one of the most important questions I think that I've been asked lately is what are mortgage rates doing here in North Orange County? And so if you're looking to refinance or if you're looking to purchase a home, it's probably a pretty important question because your finances, at least your home purchase or your refinance, is probably the biggest investment that you have. And trying to save as much money as possible through that refinance or with that purchase is definitely one of your major goals, I'm sure. So I wanted to cover a couple facts with you, just general facts about what's happening in our economy right now and how they're affecting mortgage rates. The first one is mortgage rates have been going up for about the last 6 weeks. We've seen an increase in mortgage rates of at least a full % in most cases. In some cases, they've started to come back down. It's only about 0.75%. Yet it is still much higher than it was 6 weeks ago. Investors have had a bearish mentality. They've been investing into the stock market. They've been striving after high risk, high reward stocks, which are good for them, but bad for mortgage rates, bad for the bond market, which mortgage rates tend to follow the 10-year bond, which has been increasing. And so that brings me to the next point, which was this is not what the Feds have been hoping for. The Feds announced a $900 billion quantitative easing program, which is the round 2 of the stimulus. And the reason for that $900 billion is to purchase mortgage-backed security bonds, or a good portion of it is for that. And they're doing that to keep mortgage rates low. However, the bearish mentality of the investors, they already knew that was going to happen, so they've been investing into the stock market knowing that the Feds are going to buy down the bonds, which is going to keep mortgage rates low. And so that's not really what we've been seeing yet. The mortgage rates skyrocketed, the mortgage-backed security purchases haven't really kicked in yet. I think they had one round of purchases already, which brought them down a little bit, but not enough. And so some of the key factors that should be driving mortgage rates lower are actually having no impact at all on mortgage rates. We see a national unemployment rate of at least 9.8% currently. We see inventory at twice as much as it was last year this time. And, this is some major issues. The housing market plays a major role in our economy, and if the housing market starts to take a dive again, we're going to see a major downward spiral and possibly even a double dip. So my suggestion is this. On January 7th, we have some major economic data that comes out. And if you're in a position where you need to lock your loan now, I would suggest doing it before January 7th. If you're in a position where you can wait a month or two, you're not in a rush, maybe a refinance, then I would suggest hanging out. You might get a large reward. However, it is a high risk. We could see mortgage rates climb. And so your choices are these. You can lock your loan now. You can lock your loan now and renegotiate your rate in a week or two after January 7th if mortgage rates come down. Or you can wait and run your chances and see if mortgage rates drop next week. So we're all at the mercy of what's going to happen on the bond market, and we're all anxiously waiting to see what comes out on January 7th. So hang in there, and we'll see you next week.